Hello, welcome to smarthelping.com. This is the SaaS model driven by account executive performance financial model overview. I'm going to go through each tab, explain um, what each input does, how it works. We'll go through the entire model, and don't forget to subscribe to the YouTube channel. All right, so first tab is, the index tab explains at a really high level each individual tab and some definitions. But if we start on the global control, we have the company name first. This will go to the income statement, balance sheet, cash flow statements up here at the top for formal reports. You've got the launch year. This is going to define all the timing of the entire model. It will go out for up to a period of 5 years, monthly and annual, starting with this date. If you do change this, make sure you go and change all of your other inputs accordingly, because this will adjust all the drop-down selections and everything to whatever launch year you have. You also have the end month or exit month, so that you can define when the model should stop if it's any earlier than 5 years, or it could be a full 5 years or what have you. And you can also, to do a proper discounted cash flow analysis and get a terminal value, you can assume to include the terminal value or not, depending on, you don't have to. You can just run a 5-year operating forecast without terminal value. If you do choose yes, then you would put the multiple of trailing 12-month revenue right here, and then that will give you the exit value. Next, we have cash sources. So this is if you define any debt funding, and the model looks at the total startup costs and any burn and gives you the absolute minimum equity required so that the cash balance doesn't go below zero right here. And this is after including any debt funding. Now this 3.9 million will be populated, who contributes that will be based on the cap table, and it doesn't have to be a joint venture. It could be a single owner investor operator, or you could raise money from different funds and have different investors. I'll go through that on the cap table tab though. And then these are just some uh, output numbers: total investor equity, total owner equity. This is based on the cap table, percentage ownership, and then tax rates here. And you can include tax rates or not. If you don't want to, you can zero them out. Finally, you have your sanity checks. All these should always be zero. And this is just checking to make sure all the reports are balanced with each other. Okay, so first tab is headcounts. This is going to be where you structure the ratios. And this is the whole point of the model, is a ratio-driven SaaS model that's based on account executive performance. So the first input here is you have your start month, which is when you start hiring SDRs or sales directors. You can put your starting count and the amount added per month. Now, why sales directors are basically people who oversee operations of account executives. And so, maybe you might have one SDR to, 10 or 15 AEs. It depends. And an AE is an account executive. These are people who are directly working with customer signups. This model is driven based on how well the account executives perform against their quota over time, based on their monthly deal quota. And a deal means they've signed up a customer. In this case, we're saying we're signing up, we're starting with one SDR and we're adding 0.5 a month, which means every 2 months we add one. And then the ratio I put in here of 2 simply means for every one SDR, we have 2 AEs. Now this could be 10, 20, 100, depends on your situation. And you can adjust that ratio over time, and that will adjust the head count. And then based on the total AEs that exist, and this percentage attainment of quota, which you can adjust the month ranges here, that will drive how many new customers sign up. And then based on the salaries of the SDRs, AEs, and customer service reps, that will drive your expenses, your operating expenses for those employee types. You also have ratios for customer service reps. So this says based on the monthly users added, um, essentially how many CS reps do you need in order. So if you put 20 here, it means for every one customer service rep, you can handle 20 new users added per month. And then you've also got how many CS reps do you need per total active users. So again, if you put 50 here, it means you would need one customer service rep for every 50 active users. And you can put these ratios to whatever makes sense for your specific situation and adjust them over the 5-year period. Also, finally, for engineering, we're doing engineer cost as a percentage of revenue. So that percentage of revenue, whatever the revenue is, times this percentage is how much you have allocated, and based on these salary types, it'll spit out a headcount, and you can also define the percentage of engineers that you want to make up each of the 2 different engineering types. In the visualizations, you will see headcount by type here and headcount by type percentage here. I also did just a chart for SDR versus AE because these are kind of linked, so you can see how that is looking over time as well. So that's the main meat and potatoes of the model. Now, once we know we have customers coming in, there's a churn. On the revenue tab, we can define how much are we earning per each customer per month. So we can do up to 3 tiers. Here, you can define the percentage of new customers that land in each tier, the churn of each tier, as well as potentially one-time setup fees. Now, usually businesses that are primarily acquiring new customers by account executives often have some kind of a setup fee as well. So this is a one-time cost that the user would pay when they sign up, and that's included in all the monthly summaries, details, and income statement and everything. So those assumptions will all drive our summaries and operations. Next tab, fixed expenses. Here you can define other costs outside of account executives, SDRs. So this would be like your general operations. You could do the start month of each for good strategizing, the monthly cost fully loaded of each cost type, and you could adjust that over time. We got some other cost marketing, other sales and marketing. This will also go into the calc of customer acquisition cost. We've got other cost of goods sold directly as a percentage of revenue. So this could be a whole bunch of different things. Maybe it's chargebacks or what have you. It's just going to be a cost that's a percentage directly of revenue for this one. And then for this one, you could define like a cost per user for hosting or whatever your total cost per month per user is. Would drop in here. We've also got R&D outside of engineering, which you can put some slots in for that. And then we're doing based on total headcounts, you can define a cost per employee per month and up to, what would we do? 8 different cost types there. As we move along, startup costs, these are one-time fees like consulting, legal. These are going to be things that happen before the operations actually begin, but you still need to account for them. You could also put a reserve here. This is if essentially, remember I said the model solves for the minimum equity required right here. So if you wanted to give yourself a buffer, you would put that buffer amount that you want in the startup cost as a reserve. And then in theory, when you hit zero cash position on the model, assuming all the assumptions happen just like they do, which they're not going to, but you can model it and plan accordingly. And when it hits zero, you would essentially still have this much in reserve, whatever you put in here. Cap table, so here we see the minimum equity needed. You can issue some shares and define the percentage of the different share types you have. If usually it's probably going to be all 100%, but it could be varied. And then you've got outside investor slots here, the amount they invest, the percentage of common stock preferred A and B that they get, and their fully diluted ownership share, fully diluted shares, and that will define their available distributions over here. And there's an IRR for each individual group, as well as an aggregate for that and for the owners. Owners might or might not be investing. If so, you could put the numbers here for investment, the percentage share they have of the company, and again, this will flow accordingly based on the fully diluted ownership share of that group. And then there's checks down here to make sure you haven't entered inconsistent data. Capex is next. So this is if you're going to buy equipment or anything essentially that's going to have depreciation. You can put the cost basis here, useful life, the month of expenditure, and that will flow through to the income statement, depreciation. Now building is separate at the top. There's too much nuance with that, so I made it a separate part. And here you could divide the total value of the building at sale if you're going to include terminal value. If not, this will just not be counted. The formulas automatically account for all that. As we continue along here, terminal value. This is kind of showing you the breakup of all the money you're getting at the exit if you are including exit. So these two are going to be based on the trailing 12-month revenue number. So you can see 39,763, same as this number here. But some of it might be apportioned to fixed assets. So this is a percentage you can define that gets put into extraordinary income versus fixed assets. And that will just be a tax thing with a capital gains tax. If you're fully depreciated at the end of the model, then you would just put 100% as extraordinary income. And then the sale of the building is separate, like I said. Debt schedule, if you're going to take on any traditional financing, you can put in, so this amount's coming from the global control, like we already said, but then you've got loan terms here, the start month of the loan, or when you're borrowing it, and then repayment. Now this will assume on the end month, if you are including terminal value, then any debt remaining will be paid off on that month as well. If you hit no on the terminal value to not be included, then this will just run just a normal amortization. Now we have our formal financial statements, monthly and annual. So this is the income statement, which we have our two different types of revenue, one-time and monthly subscription, total revenue, cost of goods sold, gross profit margin, our total operating expenses, startup costs. Then we drive EBITDA from there. Then we have some interest, we have depreciation, then we have extraordinary income, net gain or loss on the sale, and finally taxable income, income taxes, and net income. And you can see how that flows all the way down through for 5 years. Annual income statement is the same thing, but on an annual basis. Same numbers. Here's a check to make sure that they match. You've got balance sheet. So balance sheet, our only really current assets going to be cash. Then we've got some non-current assets based on any capex, accumulated depreciation, some liabilities, common stock. This is your equity paid in, retained earnings, and then our balance. And this always balances assets equal liabilities plus owner's equity. So balance sheet monthly and annual. Annual is the same thing, but same as a monthly, but on an annual basis. And all of this will always balance as long as you're just editing cells in yellow on the model. And this is all dynamic. These numbers all change as you change any of the assumptions. Cash flow statement's a nice view of all the different things that affect cash flow in the period they happen. So top is operating activities. Then you've got investing activities and financing. And this all flows, all these are connected, income statement, balance sheet, cash flow. So what you see here is going to inform the balance sheet cash position, and all this is all linked together with the income statement as well, and everything matches up. Cash flow statement annual is the same thing as the monthly, just annual basis. Matrix, this is how we did some of the more advanced logic for quota attainment and how many deals are actually signed up per month. Distributions is a discounted cash flow analysis. We see the monthly positive cash flow values for each year in here, the negative ones in here, and then this kind of shows you any equity that's being used based on that happening and the startup costs. So you got the IRR of the whole project. You could do discounted cash flow analysis with a discount rate, net present value, and then you've also got the investor side as a whole and the owner side as a whole. And note the investor cash flow 48.3% IRR will match the aggregate of on the cap table, 48.3. And same with the owners, whatever that might be. This model assumes all equity required is taken up front, and then you have operations. And so cash is not distributed until that's net positive, which you can see why, well, year one doesn't even have any positive cash flows, but then as you start to ramp up, you can see there are some here, and then distributions happen accordingly. Executive summaries, just a high level look. We got each tier of recurring revenue, one-time revenue, total revenue, cost of goods sold, and then the percentage of each of these: G&A, sales and marketing, R&D, EBITDA, other cash flow items, your final cash flow, and then some IRR and equity multiple numbers here for the whole project and for investors and owners based on all ownership percentages. All the visuals here, very nice look at what's happening. You've got revenue side by side, revenue stacked by type, uh, revenue against gross profit, EBITDA, cash flow per year, revenue versus expenses, headcount, we went over that. SDR and AE headcount, these are really important, these two, to see how those are related in a quick visual. Cumulative users by type, percentage by type, cumulative users by type stack, total MRR by user, gross profit margins, total MMR by user type, a stacked column, monthly cash position. This kind of shows the payback or when you kind of break even based on total equity required and monthly cash flows of the project. Annual contribution distribution for investors versus owners. And then we have advanced metrics, customer acquisition cost, average monthly revenue per user, customer lifetime value, months to payback, CAC, LTV to CAC ratio, and annual revenue per employee. Finally, we have monthly and annual detail. This is showing you actually the granular look by month of how we get everything to be calculated. So SDRs, AEs, all your headcounts up top. Here's the resulting user counts that are signed up. Here's the revenue from those users, consolidated users, consolidated recurring revenue, one-time revenue of each tier. Then you've got total revenue, total headcount, cost of goods sold. This is how we're calculating engineer counts with based on those ratios mentioned earlier. Operating expenses, debt service, and all the other cash flow items. Then we finally get to final cash flow and then advanced metrics. So that's the whole model. Remember, if you purchase this, all these assumptions need to be adjusted to fit your situation. Right now, they're just arbitrary. They don't mean anything. If you want the template, go ahead and check the link in the description box below. I'll also list this on some vendor sites, CFI, Eloquent, Definition Models, and obviously on smarthelping.com. This is part of the SaaS bundle. By itself, it's $125. With the bundle, it's $289. And you get all the different SaaS models, which there's a lot of different approaches. This is just one approach. So hopefully that helps, and enjoy. I'll see you guys on the next one.